Hello, everyone. Today we will be discussing the topic of monetary policy in macro finance. To begin, let's say that your school has multiple sports teams, each one requiring a certain amount of investment from the school for tournaments, equipment, and other expenses. The school obviously does not have infinite resources, and because of this, they must figure out a way to best spread the funds. Monetary policy is very similar to this situation in that it balances employment and inflation for the best long-term outcome. Before we talk about the tools of monetary policy, we must first define and understand the very nature of an important entity, the United States Federal Reserve, also called the Fed for short. This is the central bank of the US and it is the primary entity responsible for US monetary policy. It was established in 1913 by Congress, but it is entirely independent from the government. When we delve further into macro finance, this distinction becomes even more important. The government and the Fed are entirely separate, but they interact with one another extensively in the economy. The Fed consists of 12 regional banks located across the country, along with the Board of Governors in Washington, D.C. Looking back at our analogy with the sports teams, the Fed can be looked upon as the school's board of directors and parents who vote for the school's decisions. Neither group consists of employees of the school, even though they work closely with the staff and school administration to come up with the most viable solutions to their problems. Now, inside the Federal Reserve, the FOMC is the policy-making arm. It consists of the Board of Governors and a rotating group of regional Federal Reserve Bank presidents. The FOMC meets regularly to set monetary policy, including decisions on interest rates and other measures. Monetary policy comprises of many rules and allow the diversification of the flow of money under the influence of the Federal Reserve. While looking upon our prior analogy, we can view the FOMC as a school's board of directors, following review of the parents' votes. As they have final say in the matter, the board of directors controls the finances. We can also view monetary policy tools as the decisions that the school makes regarding finances for each team and the ways in which these decisions are implemented. The most commonly used tool of monetary policy is open market operations. The Federal Reserve will buy and sell bank bonds to affect the money supply. If the Fed wants to increase the money supply, they buy bank bonds, giving banks money. If they want to decrease the money supply, they will sell bank bonds, taking money from the banks. These are the most common operations undertaken by the Federal Reserve when it comes to monetary policy. In the next video, we will cover the different approaches taken by the Federal Reserve to change economic status. Open market operations are comparable to school bonds from our analogy, as they can be bought and traded between investors and the school. One key tool is the federal funds rate, which is the interest rate at which banks lend to each other overnight. Changes in this rate impact borrowing costs throughout the economy. The discount rate is the rate at which banks can borrow from the central bank, or, in other terms, the Fed. It serves as a benchmark for other interest rates in the economy. When the Federal Reserve increases the discount rate, banks are charged higher interest to borrow from the Fed, so more money goes to the Fed, where it is excluded from the money supply. The opposite happens when the discount rate is lowered. Reserve requirements refer to the concept that banks are required to hold a certain amount of money as reserves or deposits in relation to their liabilities. The Fed can adjust these reserve requirements to influence the amount of money banks can lend. When the reserve requirement is increased, the money supply decreases because banks have to hold more in their reserve. To clarify, money held in reserves by bank is also not considered part of the money supply. When compared to our analogy with school sports, this can be viewed as the money the school must keep in case of an emergency. Overall, monetary policy comprises of the United States Federal Reserve's actions and communications to promote maximum employment, stable prices, and moderate long-term interest rates. The pursuit of these economic goals was instructed by Congress. The Fed employs various tools to influence monetary conditions. These tools include the discount rate, the reserve requirement, the federal funds rate, and open market operations. This video was brought to you by Young Biz Nonprofit. Thank you for watching.